For the past week, GameStop and Robinhood are at the center of controversy for market manipulation.
The wild move in GameStop over the last week was fueled by the Wall Street Bets group on Reddit.
We are restricting transactions for certain securities to position closing only.
In just a few days since last Thursday, Robinhood has brought in $3.4 billion.
I'm sure you have many questions around the whole GameStop Robinhood story. What exactly happened? Is Robinhood secretly protecting its Wall Street partners? Is Robinhood doing price manipulation? Who benefited? How might this end? This video has so many pieces to go through, so I list the topics covered in the description. Feel free to skip to the timestamp that interests you. This is how it started. For years, Wall Street investors were betting against America's largest video game retailer, GameStop. The move into buying video games online, especially the pandemic, might speed up this change, make Wall Street think GameStop will follow the footsteps of Toys R Us or Blockbuster, who eventually went bankrupt. These big institutional investors started taking short positions against GameStop. If the stock price falls, they will make a profit. However, a number of good news around GameStop popped up in the last few months, including over 500% of revenue growth, a big stake into the company by the founder of Chewy.com, who aims to restructure management of the company, and a multi-year strategic partnership with Microsoft. These good news let investors believe the company was better off than the Wall Street stouters thought, so they began to take an opposite position. One user in Wall Street Bets, which is a gigantic group on Reddit that has around 2 million users at the time, found that the short interest is over 100% on GME stock. It means once the stock price started rising, there's not enough shares on the market for the short sellers to cover their positions, causing a short squeeze which might make the stock rising even faster. As GameStop value soared, Wall Street bad bets began to lose billions of dollars. Now the Reddit user want the price to rise even more as they wage an epic battle against Wall Street. Wait. What exactly is shorting a stock? What is short interest? What is short squeeze? You just mentioned a bunch of things that I don't understand. In the stock market, not only can you make money by buying low and selling high, if you think the company's business is going down, so does the stock price, you can also short the stock to make a profit. When you're shorting a stock, you're borrowing from person A and immediately sell that stock to person B. When you decide it's time to close your position and leave, you buy that stock back and return it to person A. If you open a short position at $10 and the stock price falls to $5, you take a $5 profit. If the stock price rises to $15, you lose $5. Short interest is the number of shares that have been shorted but not closed. Typically, a speculative company may see short interest go above 30%, but in the case of GameStop, short interest is 113%. More company shares are shorted than the shares existing on the market. Wait, how can you short more stocks than the number of stocks exist? When you borrow a stock and lend it to person B can lend it to person C can lend it to person D. In theory, this could go on indefinitely. So one stock can be lent multiple times even though there's not enough shares on the market. But when short interest is ridiculously high, it could cause a short squeeze. A short squeeze is an upward price move caused by investors buying coupled with short sellers being forced to buy to cover their positions so they don't take too large of a loss. But because there's not enough shares for short sellers to buy, it puts even more upward pressure on the stock price. This is probably one of the reasons that you see GameStop's price more than doubled in a single day. As GME stock went crazy, many individual investors became overnight rich. One Reddit user, he who must not be named, saw his account value rise by $1 million overnight. Individual investors, realizing the short squeeze, think the time for their revenge against Wall Street has finally come, pumped billions of dollars into GameStop, until Robinhood doesn't let you buy anymore. The New York Times reports that Robinhood raised $1 billion new equity capital after tapping its credit lines for $500 to $600 million. Robinhood needs money because a massive amount of users closing their accounts and moving their accounts to Fidelity or Vanguard. But before this, after Reddit users sent GME stock to the moon, people using Robinhood found all of a sudden they were not able to buy any GME stock. In the following days, a number of brokerages announced either halt trading of certain stocks or increase of margin requirement. An investor named Richard Joseph Gutz from Illinois is going after his financial service company when trading was halted. Gutz said he owned 2 option contracts for BlackBerry, and when trading was halted Wednesday night, he claims the value of those options decreased by nearly 200%. People who own stock or options of AMC, BlackBerry, or other restricted stocks are furious because of the huge potential losses. According to the exact definition from SEC, it makes sense for people to think Robinhood is conducting market manipulation because of intentional or willful conduct designed to deceive or defraud investors by controlling or artificially affecting the price of securities, or intentionally interference with the free forces of supply and demand, which can drive the stock price up or down. In fact, on December 17, 2020, Robinhood was just fined by the SEC for failing to satisfy duty for best price execution. According to the SEC's order, Robinhood falsely claimed in a website FAQ between October 2018 and June 2019 that its execution quality matched or beat that of its competitors. The order finds that Robinhood provided inferior trade prices that in aggregate deprived customers of $34 million, even after taking into account the savings from not paying the commission. Robinhood made these false and misleading statements during the time in which it was growing rapidly. In just a second, I will explain how Robinhood makes money and why investors are getting inferior price execution using Robinhood. Having said all these, people argue that Robinhood is blocking the trade to protect Wall Street hedge funds. So is Robinhood really trying to protect their secret Wall Street partners? Let's talk about how Robinhood makes money. Nowadays, many brokerage firms offer commission-free trading, but Robinhood is the investing app that pioneered free trading. Robinhood is named after the English fairy tale character who takes from the rich and gives to the poor. Robinhood don't force users to trade, but critics say Robinhood gamifies investing, sending regular push notifications to users about their individual stock positions. When a user makes their first trade, digital confetti falls in the app. Those behavioral nudges can encourage investors to act with only their short interests in mind. Robinhood doesn't take commission. Instead, it makes up their revenue by customer growth and payment of order flow. Robinhood makes majority of their revenue from market makers like Citadel or Virtual, who pays Robinhood to execute the trades. In 2020, payment of order flow has made the company a killing. For the first quarter, it accounted for $90 million, roughly 70% of the company's revenue. By the second quarter, it doubled to $180 million, and $111 million are from option trading. Robinhood charges the highest rate for these order flows, 17 cents for 100 equity shares and 58 cents for 100 options. Across the industry, options are way more lucrative than trades from individual stocks. Brokers might push customers to those profitable products. Robinhood wants you to trade more frequently so they can route your trade orders to market makers who pay Robinhood for the right to execute their trades. Because they're making a lot more on option trading than trades of individual stocks, it incentivizes them to push these lucrative products to its customers. We're addicted to our phone. Robinhood made trading easy and fun on the device we're looking at all day. Now that we understand how Robinhood makes money, let's get to know who are meddling behind the Robinhood story. When you buy or sell your stock on the brokerage app, say Robinhood, Robinhood is not the company to execute your trade. Instead, Robinhood immediately sends your trade to another company. In this case, it's Citadel. Citadel pays Robinhood for the right to execute their trades. And Citadel recently lent $2.75 billion to Melvin Capital, who was actively shorting GameStop and lost $13 billion and now is on the brink of bankruptcy. People say this is blatant price manipulation because Citadel is trying to protect Melvin, who is losing money and Robinhood trying to protect Citadel by disabling the buy button. But the actual story may be a lot less exciting than you think. To be fair, this does happen to a lot of other brokerage apps other than Robinhood, such as Weibo. So this may be a lot more deeper and require much more research to find out what's really going on. You see, when you buy or sell a stock, that money doesn't immediately change hand, even though it shows up in your account. Instead, the transaction goes through the clearinghouse to be recorded and settled. But what about when you bought the stock from someone who went bankrupt? When you buy your stock on the brokerage app, the brokerage company didn't have enough shares, so they go to the clearinghouse. Clearinghouse didn't have enough shares because the company they were supposed to get shares from went bankrupt. Then clearinghouse needs to buy the stocks out of their own pocket. But when the price of stocks skyrocketed, the clearinghouse simply didn't have that much reserves. Essentially, there isn't enough GameStop shares to buy because the short interest is above 100%. Clearinghouse doesn't have enough capital to cover the transaction because stock price skyrocketed. The brokerage company can't margin call the short sellers fast enough to provide liquidity, and they couldn't guarantee the stock you bought will be available when you bought it, so they disabled the buy button. But why the buy button was disabled not only for GME but other stocks as well? Because the brokerage, the clearinghouse are afraid the same behavior repeat that cause even bigger liquidity problem to the entire system. Shares of GameStop was up a crazy 94% in pre-market trading implies that many investors are willing to continuing push its value higher in hopes of breaking short bets laid by the Wall Street investors. In a matter of a day, BlackBerry's share jumped from $18 on January 26th to $28 on January 27th. AMC from $5 on January 26th to $20 on January 27th. In a post discussing its decision to restrict trading on select securities, Robinhood wrote that it has many financial requirements including SEC net capital obligations and clearinghouse deposits, adding that some of these requirements fluctuate based on volatility in the markets and can be substantial in the current environment. Sure, but this doesn't explain why Robinhood only disabled the buy button instead of halt trading completely. It's time we look at who are actually benefiting from the drama of GameStop. Many people didn't realize that institutions' money are on both sides of this bet, so I wouldn't be surprised most of this market volatility is coming from algorithm trades and high-frequency trading. This is not the first time high-frequency trading caused extreme market volatility. Computer algorithm is very fast to pick up trend and often amplify trend. These are basically computer systems to let algorithm trade on behalf of human. For example, when a stock is up by 10%, computer algorithm will pick up this trend and follow along. This leads to more algorithms to join the trend. So is the buying frenzy only going to benefit Reddit investors or Wall Street hedge fund as well? We don't really have a data point showing how many trades are made by people and how many are made by computer algorithms, but certainly there are a lot of hedge funds that are making a lot of money, killing off of this rally. So another important point to consider is how much percentage of GameStop is actually owned by institutional investors. BlackRock, the massive investment fund which seems to own a chunk of every company, including 13% of GameStop. BlackRock owned about 9.2 million shares worth about $174 million in December 2020 according to the SEC filing. That stake is now worth about $3.1 billion. Zenvest Management is a New York hedge fund that snapped up 3.6 million shares in October for $43 million. Now the stake is worth $1.2 billion. The same stake applies to Permit Capital, which is a hedge fund who has about 4.8% in GameStop in September, and Vanguard, who owns 8% of GameStop, seeing the value rise from $21 million to $1.8 billion. So it's not much of a game of retail versus Wall Street. The real reason people are furious is the rising income inequality that has been going on since the 1980s. The world is designed to favor the rich instead of the poor. What might surprise you is, in the US, people in the bottom tiers of the income bracket pays more taxes than the richest. I have put a link in the description so that you can check out the video. Thanks for watching guys. If you like this video, please hit the like button and subscribe. I couldn't be more appreciated. Hope you have a wonderful day and I hope to see you in the next video. Cheers!